Welcome to Capital Gains, Yahoo Finance's unique look at how U.S. government policy could impact your bottom line. I'm your host, Madison Mills. The stock market firmly in correction territory following a volatile week that started with the president failing to rule out a recession and ends with additional tariffs. No surprise there. We'll cut through the noise and walk you through what you need to know. Plus, Committee for Responsible Federal Budget President Maya McGinnis is stopping by the show to discuss all of this and more. But before we get into it, let me introduce my co-stars, Rick Newman and Ben Werschkel. Hey, guys.
Hey, Maddie. What's up?
So, Ben, I want to get to you first. What's on the note cards this week?
For sure, Maddie. Every week you ask me this question, and every week, at least in these early stages of Trump 2.0, the actual answer is tariffs. So my ongoing attempt is to give you a little variety. And here's what I did this week. I looked up uncertainty in a thesaurus, and I wrote down a whole bunch of synonyms. I don't know if you can see this, but we've got uncertainty, ambiguity, anxiety, confusion, unease, unpredictable, and worry. All, I think the point here is that all are perhaps kind of apt summaries of this week in markets and in the tariff fight. The S&P, as you mentioned, is in a correction after another week of chaos. Trump, just in the last few days, has threatened 200% tariffs on wine and champagne, a plan for 50% tariffs on Canadian metals that was only in play for about 8 hours, a new countermeasure to European Union countermeasures on metals. All of this is to say, I don't know which of these is going to be real and which of these is sort of bluster. And the problem is that markets don't know either. And so what we don't have is a real sense of the end game of Trump's era of tariff plans. Before I go, just a couple quick reality checks too. I do want to emphasize for folks that at the end of the day, even with all this bluster, Trump has implemented a lot of tariffs. You can measure it different ways, but by one measure, it's 2 times his entire first term. By another measure, it's 4 times his entire first term. So there is a clear way Trump is trying to what he wants here. How long his pain threshold is the big question. How long he can hold out and keep adding new tariffs.
All right, Ben, I don't have note cards, but I might one-up you on confusion. So I just, since I'm sitting at a computer, I just looked up synonyms for panic, and I'm getting a lot. What do I have here? Alarm, consternation, dismay, dread, fear, frenzy, horror, hysteria, stampede, terror. So maybe we're at confusion right now. I think we're sort of like in the 7 stages of Trump grief. We should probably create a system here and figure out how far have we gone down this chain and how much farther do we have to go? I mean, who would have thought just 2 months ago that Trump would cause a correction in the stock market? I mean, this was on nobody's radar. I think people, we did a whole preview of everything markets expected at the beginning of Trump's term. This was not even, stock market correction within 2 months was not in the realm of possibility. So Tom Lee of Fundstrat has some fun stats about the fastest corrections in the last 75 years. This is the 5th fastest decline in the stock market in 75 years. But I think it's safe to say it is the only one of those rapid stock market declines that is completely caused by presidential policies. And it's not even being caused by national policies. It's not like Congress screwed up or the whole government screwed up. It is one guy who's doing this to the whole U.S. economy and the stock market. Anyway, I'm just seeing one downgrade after another among all the stuff that I look at. Downgrades for the S&P 500 for the rest of 25, downgrades to the economic outlook, worsening inflation. So Trumponomics is looking pretty bad.
It's interesting you bring up the stock market, Rick. Obviously, this is what I primarily talk to investors about, and I haven't heard as much of a bearish tone. I like to be the optimist on the show, so I just want to throw that out there. We had Bank of America's Michael Hartnett this morning saying, yes, we're in correction territory, but we are not in a bear market yet. But to your point, Rick, I believe this is the 7th fastest correction in history. And if I gave you the examples of all the other ones, it's the likes of COVID, the global financial crisis, situations that are really not, I don't even want to give you all 7.
All right. So Maddie, so of all the people you're talking to, what is the case for optimism? Is it, we just need to get through this rocky part with all these crazy tariff threats, and then we're going to have the tariff threats are going to settle down, and then we're going to get stimulative tax cuts? Is that the the sort of optimistic outlook?
Yes, I like to joke that the stock market is gaslighting the president because they refuse to believe what he is telling us every single day, that he is
Right.
firm on these tariffs. His behavior is proving that he's firm on these tariffs, but investors just don't want to believe him. They think this is just a negotiation tactic. And they also seem to think, to your point, Rick, that tax cuts and deregulation are going to be such a positive lift to the market that we're getting kind of our policy vegetables at the start of the administration, and then we'll get the dessert in the second half of this year. But that's something I'm excited to ask our guest about later today. Are investors right about that? Are they right that we're going to get deeper tax cuts and deregulation? Because the president has also said that they're upholding Biden-era regulatory practices. So I don't know how true that's going to be, and the
Well, I
market
mean,
isn't really ready for that.
I just want to point out that the Wall Street narrative has been wrong. I
Yeah,
mean, has
totally.
been
Right.
wrong so far. So what? I mean, I see many of the same reports you do, Maddie,
Mhm.
and they're basically just saying, well, we still think that Trump is going to be good for the economy and for markets. We just didn't anticipate this this bumptious period. But I don't know. I mean,
Well,
this feels like the Vietnamization of trade policy. It's kind of like, well, once you escalate, then the other guy escalates. Well, then you have to escalate more. Then the other guy has to escalate more. I mean, what's the off ramp here? And I mean,
Yeah.
when I hear about the stimulative effect of these tax cuts, most of the so-called tax cuts are not going to be any change. They're just going to be an extension of tax rates that are already there. So I'm not sure I see like what's going to be so stimulative about that. I mean, it will be stimulative compared to if we had rising taxes, but it's like not much is actually going to change anyway.
Yeah.
I'm flustered.
Yeah, I mean, one of the big questions for me is how much, if Trump, after April 2nd, we have these reciprocal tariffs and we kind of have at least a certainty, even if it's a bad certainty in terms of people that don't like tariffs perspectives, does that calm down the markets? Because that's the ratio I can't figure out. Maddie, maybe you have insight into this from talking to folks, is how much of this is about the tariffs themselves and how much of this is about the uncertainty? In other words, if you just rip the Band-Aid off more quickly and sort of said, this is what the tariff levels are, we're going to have 30% tariffs on the world or whatever, then it's over. Do the markets calm down, or is this kind of an ongoing issue? Do you have any sense of that, Maddie, from your conversations?
I think it seems to me that it's going to be an ongoing issue just based on the behavior that we've seen from the White House. But that is what I keep
Right.
hearing investors saying, is that they think that this is just going to be an initial negotiating tactic. Having said that, we've also heard this from all of the people surrounding the president. We have Treasury Secretary Scott Bessent continuing to go on every single financial network saying all of these pro-tariff things. And just a year ago, he told clients that tariffs are inflationary. And now, obviously, this is a very pro-free trade administration. But guys, I was wondering if I could ask you a question that I've been getting a lot from the social media realm this week, which is I think people are hearing the White House talk about how these tariffs are just reciprocal. And for everyday consumers, they're like, I guess that makes sense that we would just charge people what they're charging us. Can we go back to
Right.
basics for a second on tariffs and just explain to people like what the economic ramifications are and why reciprocity may not necessarily be good for the economy?
I'll do it.
Yeah, go ahead.
So for the last 30 years, American consumers have benefited from globalization in the form of the lowest possible prices for many or most consumer goods. So the trade-off there has been that some manufacturing, not all manufacturing, some of it has gone to other countries, and it's just more efficient to do it that way. Where the United States has messed up is we have never figured out what to do about the people in, basically you might call blue collar workers who would otherwise have had those manufacturing jobs that are not there. That is the whole problem here. So when you impose tariffs, you raise the price of all goods. You raise the price of imports, but you also raise the price of stuff that's made here in the United States. So if we
Yeah.
kind of agreed as a country, okay, it's worth doing that. Everybody's going to end up paying more. Not a ton more necessarily, but more. And we want to do that because we're not sure, but we think that we will get more manufacturing jobs. Then maybe we make that decision as a nation. We have not made that decision. And the argument against that is why are we talking about manufacturing jobs? I mean, manufacturing has been declining. It's important, but it has been declining as a total of as a portion of total GDP. It's only 10% of GDP at this point. We still make a lot of stuff in the United States. We just make it with fewer workers. My argument is that is not the place to look if you want to figure out how to provide more opportunity for what
Yeah.
you might call forgotten workers. Figure out how to get them into the service economy. Where are the service jobs? Where are the value added service jobs? How do you get the skills that employers want so that you can make
Right.
a better living? I just don't think it's in manufacturing anymore. Ben, if you want
Yeah,
to
I
add
mean,
anything.
I think that's I agree with all that. The other point I would add just about the reciprocal and why there's so much confusion about this is that reciprocal is not how Trump talks about tariffs a lot of the time. He talks about tariffs as a way to the bluster version of it is balance the budget. There's no way that happens, but he clearly wants tariffs to be a big part of the U.S. revenue pie going forward, and that means high tariffs for a long period of time, potentially higher than our trading partners are. Right now, tariffs make up about 2% of U.S. revenue, of U.S. government revenues. He wants it's never going to be super high in the current situation, but he clearly wants it to be higher. And so that, if you believe him on that, you can't believe him really on the truly reciprocal tariff idea that he also pushes.
That tax revenue is paid by Americans.
Right.
There's no way around that. You can argue that, well, there are these adjustments once the tariffs go into effect. There's these sort of adjustments behind the scenes. Sure, there's a little bit of that, but the
Yeah.
products come in. The U.S. importer, that's an American firm, pays the tax to the U.S. Treasury, and then the American importer tries to pass on as much of that tax to his or her own customers.
Right.
It's a tax on Americans, and I'm sorry that people don't understand that, but it is a tax hike on Americans. Come on.
Yeah, and just a quick example, guys. If you look on the Shein website right now, this is a fast fashion company based in China. You can get a wedding dress for $15. So you would have to tariff that to an exponential degree to even begin to match.
I
the cost
I
of
have
a
a
wedding
wedding
dress
in
in
my
the
Sounds like
US.
somebody's planning a wedding. Yeah.
I'm gonna tell my daughter she can get a $15 wedding dress.
There you go. There you go. All right,
Go up
guys.
to $40.
We've got to take a quick break.
No, that
During
show's
it, we
over.
will discuss all of our wedding attire, but we're going to be right back with Maya McGinnis. Welcome back to Capital Gains. We are now joined by Committee for Responsible Federal Budget President Maya McGinnis. Maya, great to have you on. We've been talking about how the market has really misread the president's tariff agenda. And I'm curious if you can talk a little bit about whether or not investors are going to be right in anticipating the benefits of corporate tax cuts and the president's tax agenda. What are you thinking?
Right. So, yeah, it's been hard to follow all the justifications for the tariffs, and certainly uncertainty, as you all mentioned, is not market's favorite thing. So I think that that is a path that's going to continue. So the big question is, what will a tax bill look like, and how much in tax cuts is going to come through? And I think a lot of people are banking on that for the upside that they're hoping to get and the reassurance that markets will have. I am here, as always, to bring a little bit of bad news to every discussion. But the tax bill that we're talking about
The doyen
right
of
now,
doom.
yeah, that's me. Fun role. Um, the tax bill they're talking about would cut $4.5 trillion in taxes, meaning it's just extending the existing tax cuts. But because those costs weren't recognized when the tax cuts were put in place in 2017, our debt projections would be that much higher. Treasuries would have to be absorbed of that much more than had been understood would be the case. They are now talking about a tax bill that would be even bigger. So the president has lots of things he promised during the campaign, whether it's no tax on tips, no tax on seniors. Apparently, yesterday he floated more cuts in the income tax, but growing that $4.5 trillion in tax cuts to an even larger number. On one hand, markets would love that. Markets love tax cuts. But here's what markets don't like, and here's what, as a country, we shouldn't like: huge ballooning levels of national debt. And because these tax cuts are nowhere close to fully offset, they would lead to trillions of dollars of new borrowing. The current plan out of the House would have $4.5 trillion in tax cuts, another $300 billion in new spending, and $2 trillion in spending cuts. That leaves $2.8 trillion. They are claiming that growth will fill in the hole. That's always everybody's favorite claim. Nowhere near to reality, though. All of the estimates on the outside are that the growth numbers would be anywhere from maybe slightly negative because of the negative consequences of so much borrowing to about $700 billion from growth at the absolute upside. So they're assuming more like $2.6 trillion in growth. That's not going to happen. That's wishful thinking. So what will happen is if a bill like this or anything even with more tax cuts passes, the debt will go up by trillions over the coming decade. That will make markets uncomfortable at the same time that they're applauding the new tax cuts.
Hey, Maya, thanks for joining us. I want to get your historical perspective on this divide you're talking about here. It's sort of covering this. There sort of feels like you're talking about two like entirely different worlds. There's the reality that you just laid out, and there's the promises that are coming in. You mentioned there's even new tax cut promises this week. I guess I'm curious. Politician hypocrisy in terms of promises versus reality is nothing new. But how do you view this compared to previous eras? Is this unprecedented in terms of this divide? And are there any historical comparisons you would compare this to?
It's such an interesting question. It actually reminds me, I made a huge career jump from working on Wall Street into worrying about deficits and debt because when I was up in New York looking at markets, I was so struck, and this was in the 90s, really. I was so struck by how they were two different worlds, two different universes, two different language of what was going on in DC and the responses in markets, and they didn't align. But in terms of the political dynamic, the political economy, things are far worse now than they used to be. It used to be that even though the parties disagreed, there was a general consensus that you would balance the budget over a business cycle or keep it relatively stable, meaning you'd borrow during bad times, as we should, a pandemic, recession, and then run surpluses during good times. That is no longer the case. We borrow during bad times and we borrow during good times. Almost every piece of legislation these days is debt finance. The Fiscal Responsibility Act with last time's debt ceiling is really the only exception. And the reason is, and I think this is as troubling as our overall fiscal situation, but our high debilitating levels of polarization have left us in a situation where all the conversation is Republican versus Democrat. And the best thing that they have to kind of win over voters is giveaway. They love to cut taxes. They love to increase spending. They love to promise not to fix Social Security and Medicare, despite the fact that we desperately need to. They love to not to talk about the fact that we do have to raise taxes because nobody likes that. And so the political polarization has led to a free lunch fiscal environment where everybody's trying to outdo each other, and the sacrifice is coming to the economic health of the country, what we're leaving in terms of debt, what the next generation will be inheriting. And at this point, it's not just an economic risk. I think it's a huge national security risk. So the damage is tremendous.
Hey, Maya, I've been following your work for a long time. CRFB.org. I recommend it to anybody if you just want some ground truth on debts and deficits. So I was wondering how long you've been at the organization. I looked it up, 21 years, I think. And my
21
question
years?
is, in that time, have you ever made a serious recommendation that Congress has actually followed?
Yeah, you're not doing to me what others have done, which is like you could actually hold up a chart and say, what has the debt done over the past 21 years during your tenure at CRFB? And I am not kidding when I tell you that at the office, we spent a lot of time, and I may have to get coffee mugs saying this, reminding ourselves it would have been worse. It would have been worse if we didn't make these changes, if we didn't push for these changes and kind of make people aware of this. Actually, the answer to your question is absolutely. There have been many, many recommendations that we have made, both publicly and behind the scenes. The way we work is we put out all those papers, those things that you read that try to shine a light on this with a nonpartisan approach. But we also work really closely with politicians who are trying to make bills more responsible or put out bills that would be responsible. So if you recall, Build Back Better, when it started, was a huge budget buster. Trillions of dollars of borrowing, all sorts of gimmicks with all these things, just like we're dealing with the tax cuts now, but the whole gimmick of, oh, I'll put a policy in place, but then I'll have it expire, wink, wink, never meaning it will really expire. So we helped work to get that Build Back Better plan much, much improved to the Inflation Reduction Act, which in the end, we had hoped it would reduce the deficit. So far, it looks unclear whether it will because there's been a bigger take up in some of the tax credits, but was trillions of dollars of improvement. So I can say unequivocally, things would have been worse if we weren't doing
All right.
what
Well,
we've been. But we have not adopted a big debt deal, which is what we need to do at this point for sure.
That's a better answer than I expected. That's a little more encouraging than I expected. But I asked that question really because I want to spin it forward. I mean, one of the things we ask lots of people here when we talk about the national debt is, when is the crisis going to happen? I mean, you can't predict the date, but the crisis would be, and some people think we've already started to see it a little bit. It would be rising long-term interest rates, rising more than market conditions might otherwise warrant, and so forth. Do you think it's here, or do you think it's coming during the Trump administration, or it's further off?
My answer is going to be so frustrating, and it frustrates me too, but we just don't know the answer to it.
Yeah.
There is no tipping point that you can point to. There's no level of debt. There's no uh, flashing warning lights which say when you cross this, it will happen. You won't know it until it happens. There's two forms of crisis that we could have. One, which is very visible, where interest rates really start to go up, and that leads to higher borrowing costs, that grows our interest payments, which are already the second largest item in our budget and the fastest growing area. They grow more. We have to borrow more. We get in a terrible debt cycle. That happens when everybody who lends to us domestically and abroad suddenly says, I need a higher return on this. And we are seeing signs of that. And like we just discussed a moment ago, markets will also like those tax cuts, which will make the debt worse. So there will be some split personalities that we'll see in all of this. But yes, there will be signs when the markets get nervous. But that's not the only kind of crisis, quote unquote. We are already, not just that we've seen concerns from the markets, but we are already in what really will ultimately, I think, be recognized as a crisis, in that we have been borrowing too much for so long, with our debt now 4 years away from being the record it's ever been as a share of GDP in this country. The last time it was that large was after World War II, with interest payments squeezing out everything, with trust funds going to be insolvent within basically a decade. We are already at the point where these debt levels have harmed our economy. Our standard of living is lower, today than it would have been if this hadn't happened. No one gets up and feels frustrated about that in the morning, except for me, probably. But that's the reality. You can't see it, you can't feel it, but it's already harmed our economy. It's made us weaker in terms of our ability to respond to future crises when we do have to borrow. It's meant that we haven't done revisions to our social contract that we should. Our social contract right now is structured for the problems of last century. It's done nothing to deal with the huge disruptions that a tech-driven economy have and will continue to create. And we should have a social contract that helps us adapt to that. And like I mentioned, it's weakened our national security. We do not have a structure that we should for all the geopolitical risks. So there is a quote unquote crisis we are living right now. It's
Yeah.
just that you don't see the direct effects and people don't recognize how related they are.
Maya, that is so well explained. And I think we all get questions all the time from voters just about why they should care about the deficit. So I really appreciate you breaking that down for us. And that's it for Capital Gains. Thank you again to Maya, Rick, and Ben for being here. And thanks for joining. Make sure to like and subscribe to Capital Gains wherever you get your podcasts.